What is up, YouTube? What is up, guys? The Composer Trader here, and welcome back to another video here on my channel. And today we're going to be talking about how I managed to short Doge for over a 40% correction in the market when, according to most people, the markets were quote unquote looking pretty bullish. Okay, so we're gonna dive deep into the technical analysis that was applied that allowed me to catch this short position, and hopefully you guys can learn from it so you guys can benefit of these moves yourself next time as well. So as always, let's build some context. So get rid of this. What had Doge been doing prior to taking this trade? So looking back, we can see that Doge was simply making lower highs and lower lows following the 6 candle rule. And then kind of from here, we had a very prolonged consolidation phase with kind of an internal accumulation here, where we had the 1, we had the 2, model 1 accumulation kind of going over in a model 2 that pushed price higher and ended up breaking structure. Now, this break of structure wasn't really that significant because you more so looked at it from the perspective of a range deviation, because you can see how long it took in order to break structure, right? Because you had a very prolonged range in here that took some time. So I wouldn't really be convinced about this putting in a higher low for the higher high, but that's when we obviously apply 2 levels of market structure. And you guys know, if you break that market structure from top to bottom, back to bullish, that will confirm. Let's make that red. So if you break your level 2 market structure back to bullish, that's presented to you in red, your black market structure will be putting in that higher low for the higher high. So you can see just by using 2 simple levels of market structure, you can actually predict these high time frame pivot points very accurately. Okay, so right here, we broke structure. The moment we break red, that confirms the rotation back up towards that black high. And prior to breaking red, you actually had an accumulation in here. But that's all that Doge basically did. Because from that higher low right here, price pushed up very aggressively. And obviously, the entire market around Doge was bullish. The sentiment was extremely bullish because of Elon Musk posting about, the Department of Government of Inefficiency in America and all that stuff, allowing people and causing people to call for crazy targets. But you guys know, right, if we have an aggressive move towards the upside or just an aggressive move in general, what does price loves to do after having an aggressive expansion? It loves to create some sort of a range, right? It loves to create some sort of a range. So since we are trending up aggressively, you guys know if we are trending up, we pull our range from top to bottom. So right here, we have our high, we have our low. Let's use our range tool right there. And the moment we have a move back up towards the equilibrium of that range pool, that means that we confirmed the range. And at that point in time, we have our range high right here and we have our range low right there. Now, obviously, even though Doge is on the high time frame very bullish, it's completely normal, just from a thought process perspective, that you can get a distribution here to pull back to simply put in a high time frame higher low. Like, just thinking of that rationally, that's completely normal. You pumped up this aggressively, you can easily get lower time frame distributions in here that can cause a higher low for the weekly time frame, because that is still bullish. Okay, so just because we are trading a distribution, that doesn't mean that it's the top and the macro top for Doge. It simply means that distribution, the purpose of that distribution, can be to put in a higher low for the higher high on the weekly time frame. So zooming back in, we had our range high, we had our range low, and then price came up and we SFP'd that range high, truly showcasing this as a deviation. What do we always do? After price deviates our range high, we extend our range to the deviation high and we look for potential distribution models. Okay, now we can get a model 2 distribution, or we can get a model 1 distribution, and we always need to look for both. Now, if we want to have a model 2 distribution, the third tab needs to either sweep extreme liquidity and or mitigate extreme supply. So zooming in on this range, what would be our extreme liquidity and or extreme supply? And looking right here, we can see our extreme liquidity will always be the first high time frame or the first decent market structure high that gets created following the structure from top to bottom after putting in your second tap. Now, that is a mouthful, but what that simply means if we have to measure the market structure from that second tap high down towards the low and see, applying the 6 candle rule, where that first market structure high was created. And you can see right here, following our market structure from top to bottom, that first market structure high that was created was right here. And therefore, that is our extreme liquidity. Okay? That is our extreme liquidity. Now, we can also look, just in case, where is our extreme supply. And you can see right here on the left, price pulls back, goes back up, creates that second tap high, and then dumps back down, leaving behind this structure supply that just got front run on that tab right there, as you can see. So it's always extra nice if you have your supply aligning with that extreme liquidity, because it just makes for a very easy POI. Okay, so the moment price exceeds that extreme liquidity point and mitigates that supply, this could be a potential valid third tap for a model 2 distribution schematic. Okay, now what was so significant about this potential model 2 distribution is that you had an amazing return to zone. You had an amazing liquidity curve below you. So right here, from this low all the way towards the creation of that third tap right there, you can see that price is curling up extremely nice, where all these lows are stacking up to be higher lows. Now, what does that indicate? That simply indicates that the people that longed at the bottom right here, what they tend to do is they tend to put their stop loss below the previous swing low. So the people that longed here put their stop loss right there. The people that longed here put their stop loss right there. The people that longed here put their stop loss behind there. So if you have this slow grind up where all these lows are stacking up to be higher lows and are not taking each other out, that means you have a lot of liquidity of stop losses below you. Now, what's going to happen once that first low gets triggered and once that first stop loss gets triggered, that will then cause a sell order because these people are buying, okay? And if their stop loss gets hit, it's a sell order. And that sell order is going to cause a trigger move down. And that trigger move down is going to cause price to hit the next stop loss. And that again causes a sell order that's going to cause a trigger down. That hits the next stop loss, that again causes a sell order. And you get this snowball effect of these sell orders getting hit, causing price to have a very aggressive and fast move down because of liquidations. So the fact that we had this return to zone, that is truly what made this potential model 2 distribution schematic so significant, okay? It was setting itself up to be absolutely amazing. Now, when do we confirm a model 2 distribution? We have our 1, we have our 2, and then we have our 3. In order to confirm our distribution model and therefore also confirm that price will have a rotation back towards the range low, we need to watch the market structure from the lowest point between tap 2 and tap 3 up towards our third tap high. And when that breaks back to bearish, that's when we confirm our distribution model. So you have your tap 2 right there. You have your tap 3 right here. This is the lowest point between tap 2 and tap 3. And now we need to measure the market structure from low to high to see where that market structure low is that we can wait for to confirm a potential short position. Now, in order to do so, you don't have to start all the way down here because all these points are irrelevant. You just need to know what was the most local pool, okay? So we're going to go and zoom in on the lower time frame. And you can see right here, coming into that pivot point, right there, coming into that pivot point, following the 6 candle rule, you have higher lows and higher highs just like this until right here on Monday during the Asia session at 4 in the morning, price has a closing price below your market structure low and therefore confirming a break of structure, okay? So right at this point in time is where your short gets triggered. You put your stop loss and the invalidation above that third tap, and your target of the distribution will be the range low, okay? making for a absolutely amazing 7-to-1 risk to reward. So if you risk $1,000, you make 7,000. And if you risk 100, you make 700, etc. Now, I took this short position. However, it is very crucial that you pay attention to what happened next, okay? So, because this is a piece of trade management. Right here, we confirmed the distribution, and a few hours later, I entered on the pullback because I wasn't awake at 4 in the morning. But I entered right here around 7 in the morning on that pullback, okay? Now, what we were expecting was a very easy move down, an easy liquidity move down, because there was nothing here to really hold price up, but all these lows stacking up, and we were expecting that snowball effect of liquidations getting hit, causing sell orders like we just discussed. Instead, what happened was that price was trending down, putting in lower highs and lower lows right here, until it started to create a range right here. Right there. It started to create a range instead of having that aggressive follow through. And guess what this range did? This range had a range low, it had a range high, and then it deviated the range low, showcasing potential signs of an accumulation. So just like we did with the other ones, we're going to extend that range low to the deviation low, and now we can potentially watch for an accumulation. Because you can easily have an accumulation inside of a distribution model, especially because this accumulation could have the strength to push price up to create a Model 1 distribution instead of a Model 2, which is always a potential scenario. So now we just have to check, okay, where are the POIs for the third tap from this local accumulation standpoint? And what we have right here is following our market structure from the low to the high, right there. This was that first market structure low that was created. So that was your extreme liquidity. And right below that, you had your extreme demand right here as a pivot point order block. As you can see, we just front ran our POI. We just front ran that POI, therefore not making this as a valid third tap. However, it was looking really good from the accumulation side because we were leaving such a beautiful liquidity curve above and all the juicy stuff, okay? So the moment I saw this accumulation, I was like, well, that wasn't part of the original plan because we were expecting a flush. So the moment I saw this break of structure back to bullish, I wanted to hedge my short position. So I wanted to open up a long while being a short to hedge my position out, but it wasn't a valid long, so I couldn't take the long. However, what I did is I put my stop loss that was originally right here, and I put it to entry right there, okay? I put it to entry because we were accumulating, and I was expecting price to come here, and then from there, price could eventually go higher and take that high one more time to create a potential Model 1 distribution schematic, okay? So what we saw right here, and this is part of that trade management, if you see an accumulation, you want to de-risk yourself, okay? You want to not risk any more money on the trade setup. Now, there was a possibility that this accumulation went over in the distribution, but our entry was already here. So if it went over in the distribution, then we would just re-enter at the exact same price point. But it's not worth it anymore to lose money on a potential trade like this. So we de-risked our position, price ended up moving higher, stopping us out of the trade, and now I was watching for a potential Model 1 distribution, where at the Model 1, we take that high one more time, okay? And as you can see, again, on the Sunday, going into Monday kinda, you had the exact same setup where you took that high one more time, confirming this as a Model 1 distribution, while after accumulating, maintaining this beautiful return to zone where all the lows are stacking up to be higher lows, as you can see right here. All these lows are stacking up to be higher lows because you can see right here after the accumulation, we had 1 low, 2 low, 3 low, 4, 5, 6, 7. They were all stacking up in this entire move up, maintaining that amazing return to zone. Okay. So again, how do we confirm the distribution? Now, we measure the market structure from the low to the high between type 2 and type 3, but we're not going to measure all the way from there. We're just going to watch what was the most local structure before it broke back the bearish below that second high. So we're going to go on the low time frame. We're going to go on the lower time frame, and you can see following the 6-candle rule. Let's put that perfect. Following the 6-candle rule, you can see that right here, we had a low, high, higher low, higher high, and right here we had that breakout structure. Okay, right there we had the breakout structure. So at that moment in time, price confirmed that we were in a high time frame model 1 distribution. So I started to scale in on that breakout structure. However, we did have some demand below that I was cautious of. Okay, I am looking right here. You had this 30-minute demand zone where price could react of. So I started to scale in on this breakout structure, and I was looking for a bounce off of it. And then if we were to break structure of this low towards that high, if we broke that structure back to bearish of that local uptrend, that would confirm, applying just simply 2 levels of market structure, that you were going to get the lower high for the lower low on the higher time frame. So if I represent that in the chart to you guys, you can see that right here we broke structure, not on the 30, but indeed on the 10-minute. So that broke back to bearish. Now, expectational order flow after a break of structure is lower high for the lower low. But that lower high for the lower low is only going to take place if you break your market structure of that local uptrend back to bearish right here. So in order to get from that low to that high, you will have some sort of bullish market structure. Now, if that breaks back to bearish, that will confirm the lower high for the lower low on our red market structure drawing. And then that's where I will enter the rest of my position. Now, if we get some sort of a redistribution model in that area, that is just even better. Okay. So exiting replay mode right here. What we ended up getting was more than I asked for. Way more than I asked for, because right here we had that breakout structure. We got that bounce that we were expecting. Came in this supply zone right here for a retest. Right there. Beautiful structure supply. And in that structure supply, we created, following this local uptrend, we created yet again another range right here that ended up being its own distribution model with your range high, your range low, your deviation 1. After your range high, or after deviation, you extend your range high to the deviation high. Right here, right there, putting your third tap, and later on Monday open, and the people inside of the TCT trading community, they know how much I love my Monday opens. We actually came back for extreme liquidity, kind of confirming this as an extended model 2 distribution while leaving an amazing return to zone, while having a range inefficiency because there's no price action right here in the discount section of this local range. Man, oh man. Your entry right here could have been on this break of structure, back to bearish, right there. That would have been your short of this reaccumulation model, and you can put your stop loss below this distributions model high, and then you can target the entire distribution, high time frame distribution models low, really increasing your risk to reward all the way up to a 24.04. Meaning if you risk 1,000, you make 24,000. And guys, I'm telling you, trading these models, okay, consistently is going to net you way more than hoping for any sort of meme coin to do with 24x, okay? And what followed from here was just what you expect after such a distribution model. So we had a very aggressive move down that already grabbed a lot of liquidity on the left, And this is exactly what I'm talking about. This fast move down that you can see right here that also wicked up pretty aggressively, that is not because people are opening up short positions. No, that is because all these stop losses that we were referring to with the snowball effect were getting triggered, causing this cascade event towards the downside full of liquidations. And from there, we had a very aggressive move. Price ranged for a few days before finally hitting our target. And I had a 75% take profit at the range low. And I took the rest towards kind of this structure demand and the 0.5 of the entire swing move to kind of cash out that extra bit of juice right here. So I exited the rest right around here. And then this was my short position. I did keep my stop loss above that main high. However, I did took a higher risk position than simply just 1% because this was such a high probability model. So what we basically had was a model 1 distribution where you had a breaker structure, and on the retest, you had yet again another redistribution, which is simply just trading the same model twice to get such a good risk to reward. And obviously, these TCT models, guys, they are all based around Wyckoff. Okay, so as you can see right here, for the people that are new to the channel, TCT distribution and accumulation models are Wyckoff accumulation and distribution models, but inside of the set of rules that we have made, that I have made as the composite trader. Okay, so you can see right here, if we compare it to a Wyckoff Model 1 distribution, you can see that tab 1 represents the BC, tab 2 represents the UT, and tab 3 represents UTAD. And you can see we even had that lower high right there, which is the test. And then we had that entire reversal back down all the way in phase E, which is right here. Okay, so we're trading, what we do at TCT is we're trading Wyckoff models, but we have made it into an actual tradable and effective and profitable concept for you to benefit off. Because if you try to apply all these letter combinations, it is not going to work, okay? Or these phases. It's simply a range where you have a deviation 1 and a deviation 2, where each deviation goes higher than the previous one. And applying that with our range rules, with our market structure rules, you're going to become very, very profitable, okay? So it's very simple, guys. You know, you have to be able to distance yourself from your emotions, from the money that you're putting up on the trade. You need to be able to look at the chart objectively and then take big decisions like this to go hard short when literally almost the entire crypto space was calling for Doge is ready to leave the station, Doge is going to go to $1, and then we're right here shorting and predicting a 40% correction. Okay, so I hope you guys learned something from this video. If you like my style of trading and my style of teaching, I took this trade live inside of the TCT trading community. It's an absolutely amazing community of already great traders that are studying the TCT concepts. And you can see that we took this trade with the entire community. So you can see, started the course yesterday, learned a lot from lecture 1 already. But right here, you have me taking the Doge trade. You had Mr. Irish Dan taking the Doge trade. You had Tasty absolutely nailing it, 1,100% gain, absolutely insane. G-Say taking the Doge trade as well. Shout out to CJ. It's absolutely amazing that I can share these trade setups with you guys and not only benefit of these moves myself. So if you're interested into joining, you can find that link inside of the bio of this video. And I'll see all of you guys into the next one. Peace out.